7:05, let's get started. I'm going to welcome real quick Michael and David Cito. They're twins out there in Texas. We'll get to them later, but they're agent PMs and they work with investors. So just a quick heads up, they are selling a product, but they also have the most expertise in this spot. So if y'all are looking out in the same market as Annie is, they're the people to talk to. So today we're going to talk about the offer. Offer is pretty important. You find the property that you like, you underwrote it, it all makes sense. At a certain point, you're going to want to put in the offer. So,
hi, Lynn. How are you doing?
How's it going?
Pretty good.
Good, thank you.
Oh, someone's on a call.
So, how was your day? Have a good day.
Yeah. Someone is on a call. All right. Cool. Long story short is I don't want to go over the agenda because agendas are boring. We're just going to go straight to the point, which is what are you going to put in an offer, right? Kara, I saw that you were here. You've been looking at homes. What sort of property and cash flow like machine do you have on your mind? And when are you going to put an offer in on it?
Oh, hello. Not sure what you mean by machine, but I'm generally looking at duplexes in the Northwest OKC area, purchase prices between 140 and 180 being at the upper tier. And I'm probably going to start putting in offers a few months from now. I had to push it back because of pre-qualification things, but
Makes sense.
I'm thinking around March.
Okay, cool. Well, do you know all the parts of your offer yet and what you're supposed to include in an offer?
No.
All right, perfect. That's exactly what we're gonna go over. Earnest money, first things first, is a deposit, that you're gonna put on the property when you give them an offer. Essentially, it's gonna go towards your down payment, but you say like, hey, I wanna buy a home that's worth $100. I'm gonna put down $5 just so that I'm actually interested and I'm not just, throwing something in the air. This is usually a part of the contract just to show, that you're interested. The higher the earnest money, the more interested that you can show that you are. Closing date, that's very important because you want to know when you're going to be able to buy the home. Usually it's like 1 month, 30 days, and 10 days if you're doing a cash offer. How much are you buying it for? Believe it or not, you need to put a sales price when you're putting in an offer. Giving multiple options is one way to negotiate. It's one way to show that you're more willing to work with the buyer, so you can, or with the seller. So you can give them like a 1 month that's like, I'm gonna buy a home for $100, but I could put in a cash offer right now for 90, depending on how badly you need this money, right? So that's one way to make yourself seem more reasonable. I remember back in my old school, they came out with a study that said essentially when you're negotiating, the best way to seem reasonable is to give a range. Right. So this actually applies when you're applying to jobs and they're like, what sort of salary range are you looking for? Don't give them like the highest number you can think of. Start with your target number as the bottom range and then go higher. So if you're trying to make 100,000 a year, just say, oh, I'm looking for anywhere between 100,000 to 110,000. That way you seem more reasonable, and it seems like the 100,000 is something that is like within range of what we were trying to get. So if you give them the low end, it makes them feel like that you're working with them. So after that, your picture and your cover letter, this can make a difference because when people buy homes, believe it or not, it's almost like applying for a job. You submit an application and then you show them, hey, I'm a family that's looking to move into your house because I've lived in this neighborhood forever. And that's why you're gonna want people to know that I have a face that's buying your home. Please sell it to me because I have this quality or that quality, and it can make the difference. So contingencies are pretty important as well. In your offer letters, you're going to want to put some contingencies, which are clauses that say, hey, this thing happened and I want that earnest money like in deposit back, right? Because earnest money is not small, especially like if you're buying like a $4 million apartment complex, your earnest down payment is like $100,000. So you're gonna want to get that money back if anything happens. Long story short is you wanna make sure you have a inspection contingency or due diligence contingency if you don't know what you're doing yet. the inspector is somebody who not only will check the home for you to make sure there aren't any major issues that you can negotiate off the final price or through credits, but the inspector will also sometimes guarantee their inspection. So that means if later on down the line in 2 years, like the foundation of your house, starts to give way and there's like a sinkhole or whatever, you can actually go back to that and the inspection company and then make them cough up on that warranty. It depends on how long the warranty lasts. Usually it's like 2-3 years. You can go back to them and say like, hey, y'all told me this was good and it broke, give me my money. So that's one contingency. You're usually going to want people who are like more specialized. They'll remove this in order to make their offer look better because they've walked a bunch of homes before and that's not an issue anymore for them. They're their own inspector. And then financing contingency, you can back out if you can't get the mortgage. Believe it or not, there's a lot of people who don't get financing. Even if you're pre-qualified, sometimes things come up and it just ends up not happening. You can also get an appraisal contingency, which is a third-party appraiser comes out and says, hey, this home's nowhere near what you're buying it for. And usually you're going to require an appraisal anyways from the loan company. So you can add it, but it's the more contingencies you add, the less good your offer looks. If somebody comes in and says like, hey, we're going to put in a cash offer due 10 days and have no contingencies, right? Usually inspection you're going to want to include, but all the other ones, they're not as popular nowadays and only work when you're in a hot buyer's market, not in a seller's market. So then there's title contingency. Homes can have liens placed on them. So for example, if I hired a contractor that said, was going to do some work and fix up my roof and then I don't pay them, they can put a lien or like essentially a judgment on my house and it gets tied to the house when I sell it. So you can put that as a contingency. If there's anything that appears, then you can say, hey, I want my earnest money down payment back. And then there's the home sale contingency, which also is not that popular nowadays, especially because it allows the buyer to sell the home to somebody else. Very uncommon now. But yeah, those are the contingencies you pretty much would think about when you're trying to buy a home. Do you know your market that well, Kara? Do you know what's popular there? Do you know if people are going through inspection contingencies and then some, or like any thoughts? I'm calling on you in the class. This is what's happening. Kara? Hello?
Oh, sorry, what was that?
Do you know what the earnest down payment and sort of the contingencies that are popular in your market are?
In my market? No,
yeah.
I haven't done that research yet.
Yeah, it's okay. You don't have to know. That's what the agents are for, which brings me to the next part, which is you're going to want to vet your agents and your property managers. These are the people who are going to help you find the property and take care of it. You're going to want to do your own research. I have some resources here on the website, and ideally, the most important thing is actually meet agents who work with investors. A lot of agents are just people who sell homes to people who are looking for a beautiful first home. You know, there's not actually a math requirement. I'm trying to get my broker's license in Texas right now. There's, you know how much math I'm doing? I'm calculating the area of a square because that's what matters when you're an agent. You're calculating lot sizes. You're not doing IRR multiples. So the long story short of it is that's why I brought Michael and David. They are PM/agents extraordinaire in their markets down in Texas of Austin and Dallas. Not Austin, sorry, Houston and Dallas. I keep getting that confused. Did you know I actually booked a ticket once for Houston thinking I was going to Austin? And my friends were like, no, what do you, stop. I'm like, it's, you can't do stuff like that. Long story short is I want to give them an intro because they have their own presentation. So without further ado, if you guys could give an intro to yourselves.
Well, thank you for, I guess, putting us on. This is the first time we've gone into your Facebook group. I think it's a fantastic group. I'm amazed how many members you guys have. Congratulations on building that up.
Thank you.
And I guess I think I have to give a lot of thanks to my favorite client Annie Lou. She has done nothing but promote us. And I think that's probably the greatest compliment that we can ever get from any client. Thank you so much, Annie.
I love you guys so much, so much.
This is how Annie gets first dibs on the best deals, by the way. I don't know if you can tell what's happening, but she's getting all the good stuff that Michael and David find. So
I have to admit that was one thing I told them is that, you know, heads up, I'm going to be throwing a lot of great leads your way, but in return, I'm broke as hell. So give me all your best. Pass it on to the other folks.
Oh, so what we're gonna do is we're probably gonna go ahead and just go through how the Texas market is with you guys. And I'm sure everybody is familiar with their own market. And, you know, Texas is it's a different market than what you guys are used to. We are not California, we're not Oklahoma, we're not Arizona, you know, we are Texas. And I guess let's start with what you need before you start investing. I don't know, can we put that presentation on, Nelson?
yeah, I made this screen. I made you co-host, so you can just click share screen. There's a green share screen button at the bottom, and you can show ours.
You know, I shared it. Are you guys seeing it or no?
I'm not seeing it on yours. You're sharing it?
I thought I am. Hang on. How about now?
Nope, still not.
Okay. Technical difficulty here.
Technical difficulties. Yeah, worst case scenario, you can share it with me and I can scroll through it for you if you want. But
Here, I think I know what it was. So let me go back to my little Zoom thing. Share screen. Where is it?
yeah, in the meantime, I'll just keep talking. But basically, when you are looking for your agents, you're going to want to vet them. I have a list of questions to ask your PM as well. Your PM is going to matter a lot, especially somebody who's able to answer quickly and help you resolve issues. Most of the time, if you're buying single family investments, your PM fee is going to be like around 10%. So it goes down the more units you have, but that's usually a good way to budget once you're looking to buy. Don't always go for the cheapest because sometimes they don't actually take care of your property. So that's something to think about. All right.
You guys seen it at this point?
Yep, got him.
Awesome. Dave, you on?
Yep, I am. Okay, so what you need to know about investing. I think some of the things that you need to know. First thing is you need to have proof of funds ready when you're investing. A lot of times these properties that you're investing it's either MLS, it can be off market, and you know, whenever you put it in, you want to be able to show that, hey, I have the funds available, I'm ready to go. So guys, pick me, right? And you know, and that basically hits us right at the pre-approval letter. Now, when you are investing, one of your best resources are your real estate agents that have that investment knowledge that you need. So make sure you interview them and find out, ask them questions. Hey, realtor, what do you know about investment? Can you tell me and share your knowledge with me? And you know, as far as the ones that actually know what they're doing, they can tell you right away, okay, this, what are you looking for? What kind of returns are you looking for? What kind of investment strategy are you looking for? Get into all those numbers. Have all the knowledge that you need. When you do identify your property, make sure you know how to figure out what your rehab cost is going to be. Have enough knowledge and resources to find out. If you don't know it, bring a contractor, bring a friend that actually have some experience. Figure out, okay, here's my property. What do I need to do? What do I think this is going to cost? This ultimately is going to affect you on your bottom line. So if it's a 80% deal that you're getting, and your cost you're estimating maybe 10%, and it turns out to be 20%, you're really squeezing your profit margin quite a bit. You're leaving 10% for yourself if you miscalculate that. So that's a very, very important part of finding out if the agent can help you along that process. Then find that agent that can help you find a discount deal for an investment or an investor. You want to be able to identify deals that is discounted. If you're buying off the MLS, more than likely you're paying market, right? If you're buying off of market price, you're not getting extra equity that you want as an investor. If you can find and identify those properties, then it will give you an edge as far as investing. Now, as far as Texas, what we have in Texas are 4 categories that we kind of try to focus on. We have wholesale properties, we have foreclosures, we have MLS deals, and we have portfolio type of properties. Now,
Explain portfolio property. Oh, you're going through the list. Never mind. Sorry.
yeah. So wholesale properties, these are real estate deals that we're getting from wholesalers. Wholesalers typically are investors. They go out and they find these distressed properties. Usually they get a pretty significant discount. And what they're looking to do is they're looking to sell the property as is, right? And as far as what they're wanting to do, they're trying to get a contract so they can make a quick profit on it. When they get it, they'll try to sell it, and what they'll typically do is assign it. And that's basically, I think what you mentioned earlier, Nelson, is buyers selling it, right? So they get a contract, they'll assign it to you. But you know, as long as it's got a good margin, then it's worth it.
Yeah.
Now,
The way we actually talked about this last time, but yeah, the best way to explain it is you're not buying the home, you're buying the contract to buy the home. So
correct.
You're exchanging a piece of paper that had some earnest money down, sales price, you know, the thing we talked about in the offer earlier. And that is what's moving between people when you buy a wholesale property.
And then, you know, the other categories we're looking at foreclosures. Sometimes you might hear it referred to as REO properties, which stands for real estate owned properties, right? Foreclosures are usually what happens is it's a buyer buys a home and they're unable to maintain their mortgage payment. So they end up defaulting on it. Because they defaulted, the bank has taken action and they're taking possession of it. So what they're trying to do is they're trying to just get their money back. And typically what they do is they'll sell it at a discount so they can get it off their books. And you know, you as an investor, if you happen to get your hands on that, you're usually getting it at a significant discount compared to normal MLS deals. So
I heard also from Michael that there's going to be a lot of foreclosures down the pipeline, you know, once forbearance ends. Is that correct?
I think we're looking at.
I can answer that real quick. I think a lot of investors today believe that there's going to be all this big giant amount of inventory and foreclosures coming. The answer is there's going to be a blip in the beginning of next year and probably another blip in the summertime. This has kind of misled a lot of investors out there who's misinformed. This is also all the unemployment has misled a lot of the real estate agents out there who's unaware. So one thing that most of you guys don't know about me is I am sitting on the board of a default task force nationally. So I am actually very, very much connected to asset management firms, Fannie, Freddie, HUD, and all these folks. So the thing is, all the economists on the foreclosure side and all the asset management firms, and we believe it and we see it too, that all this unemployment, the inventory is not as high as we all anticipate. What it is we have a whole lot of appreciation over the last 7-8 years all across the country. So with all the appreciation, if you think about it, you've bought something at $100,000 5 years ago. Because of the rate of appreciation over the last 5 years has been so high, this asset could be worth $170,000 at this point, right? So there's $70,000 in equity. So if you are where you're unemployed and you got the foreclosure notice, the first thing you're going to do is, I'm not going to lose this house to the bank. You're going to call a real estate agent to sell it and walk away with whatever you can walk away with. Why give the equity to the bank when you can take some of it back, right? So that's what they're going to do. And also it's going to save them from a foreclosure being on their credit. So foreclosure, yes, a small increase in inventory next year, in the next 2 years, but it's not going to be as much as investors anticipate. The areas of foreclosure that you're going to see more of is typically from the FHA and the VA products, because those are the low down payment products. And because of the low down payment, they have the least amount of equity typically. So go ahead, Dave.
Okay. So our fourth category that we like to focus on is the MLS properties. And I think those are pretty obvious. Those are the properties listed on multiple listing services, right? That's probably where you see the most exposure. That's where all the realtors are showing the properties. There's that's where you guys are seeing properties off of Zillow, off of Redfin, or whatnot, right? Now, I think the exotic one, this is the portfolio properties. This is a group of property that pretty much falls under one organization, usually like a hedge fund or some big organization like that. And what they're doing is they're trying to sell a whole package. And usually when they're selling it at a discount. Now, we do see at times the possibility of going in and cherry picking specific properties out of these portfolios. And every time we see the opportunity, we do try to take advantage of that.
Nelson, we actually just made an offer on a portfolio of 21 properties. They had a portfolio, it was filled with 45 properties, and we cherry picked the ones that we liked. And I believe we offered them $1.2 million for it. But it is where we're getting it at about at a 65% of their BPO values. But according to our values, we're getting it at about 55 to 58 cents on a dollar. So we'll see if we'll get it or not. It's still there. The offer's been sent to them 2 days ago. We believe that we'll hear back maybe tomorrow. From the feedback I'm getting, I think we're in the neighborhood of possibly getting it executed. So we'll see.
So, yep, these portfolios, usually it can be notes, it can be single family, and it can be commercials or whatnot, right? Now, I think for a new investor, one of the first things that you probably need to do is, before you get into investing, you need to create an investment policy. What is an investment policy? Basically, what that is what's your objective, right? The investment policy keeps you basically disciplined. It keeps you where, okay, this is how I want to invest. And you need to be able to go back and say, okay, I want to look at properties that's under $250,000, right? And that's less than 15 years old. And I want it to be at least 4 bedrooms. And, if that's the case, it's something that I could focus on a flip or buy or hold or whatnot. So what is it that you want to do? So you want to plan it out and basically define what you want to do. So if you have your investment policy, it keeps you kind of down on, I guess, settle down where you don't lose track of yourself. You want to focus on that and just stay on course. And I think a lot of people, whenever they get into it, they need to figure out how they can come up with a formula for their purchases. Now, for a simple formula right here that we have set up is, what you want to do is start with your purchase price, and then you want to figure out based on your estimates, how much repair do I need to do? The house is worth say it's worth 200,000. You're getting it at 100,000, which is a fantastic price, but it wasn't in a very good condition. So you were going to have to do some repairs. Maybe it's going to cost you 40 grand to repair it. Well, if that's the case, then it's going to end up costing you 140,000, right? But that's not quite yet. You know, you still have closing costs. What's the closing cost going to run you? Now, and you also have commissions whenever you sell it, right? And then there's all that will at least give you an idea of what your acquisition cost is. Now, as far as what your ARV is, that would be 200,000. After you repair it, it's in tip-top market condition. This is what it's worth. So minus your acquisition costs and holding costs. A lot of investors, they forget about holding costs. Now, what that is it's your insurance, it's your taxes while you're holding it, and any other expense that might come into play. You might have to fix something while you have it. Maybe somebody comes in and trips and maybe breaks something on the property, and that's going to cost you more money. That's going to be holding costs. Then when you sell it, you got your commissions, your taxes, your closing costs, and what's left is your net income. That's what you're going to make out of it. Your total cost is your acquisition costs plus your holding costs. Your net returns now is your net income divided by your total costs. So you should only purchase it if your net returns fits what your strategy is, what's the word I'm looking for?
Anticipated returns.
Correct. What your
cash on cash return, or whatever terminology you want to use, I guess.
No. That's we just went over it. Investment.
He's getting old. He's having those
policy,
ships, right?
Mine locked up. Okay, it's an investment policy, right? That's your investment policy. If your investment policy says it needs to be 7% return and it's 6, then it doesn't make sense, then you should not buy it. Now, if you're doing it and if your investment policy is 7% and you're coming up with 8%, then numbers is that's a buy, right? Mm-hmm. So know how to calculate that. Now, what can you do with an investment property? Well, first thing that most people do is they buy it and they hold it. They buy it, they rent it out, they hold it. They get that cash flow out of it. Now, that's I think is a good strategy for a lot of beginners to get into. Now, your second strategy is flip property. I think that should be a little more advanced, right? Because if you're going to get into flip, you definitely need to understand how to evaluate the property. You need to understand how to figure out rehab costs is. You need to figure out how to market it. There's a lot of different scenarios you need to be well versed in. And the next the next way you can attack a property is there is a strategy where you can wholesale a property. Now, I don't think a whole lot of people know what wholesaling a property is. So this strategy, basically what you're doing is you're getting property that's significantly discounted. It needs to be a deep discount on it where you buy it, you do absolutely nothing to it, and basically you're going to turn around and sell it. You're basically flipping it and not doing anything to it. So that's what wholesaling is. And typically with a situation like that, you have to have a significant discount. Now, another strategy is you can owner finance it. So when you owner finance a property, you usually purchase property at a discount and you're holding the note and you're acting as a bank. Basically, you find a buyer and you're basically telling them, I'll be the bank. Here, you buy this property from me and this is what I'll charge you for interest. This is, I need from you, and this is what I need, how I need you to pay me. And now you see on point 3 there, an owner may finance 5 times per year, according to the SAFE app. So there is actually a limit to that.
Hey,
Now,
Dave, I think they've gone over some of this stuff before, probably in their classes. Let's
Okay.
kind of go over the 10 Commandments real quick.
Okay, yep, the 10 Commandments. Well, these are pretty much our foundations for how we should approach investing. Now, first one, thou shalt have knowledge of repair costs. So that means, like we mentioned before, you need to know what it's gonna take to get a property up to the market standards. Now, the second point is, thou shalt have an updated CMA. So what we want you to do is, before you buy a property, make sure either you or you have your realtor run a comp for you, so you know what that property should be worth. Now, third point is, thou shalt have an investment policy. Make sure when you're investing, you set your guidelines on how you want to invest and stay within those lanes. Okay. Now, fourth item is, thou shalt have cash for purchase. You need to have the funds to do it. If the more cash you have, obviously the better off you will be. But you have that cash, you may be able to get better deals, because there's plenty of cash deals that's a little more discounted than what you might get off of a leverage deal. And fifth item is, thou shalt have patience. Be patient. Don't rush into it. Do your due diligence, right? Sixth item, thou shalt have a reserve funds for anything unexpected. A lot of new investors may not think about that, but for a investor, they need to go into it, and once they start their project, at least expect there are things that you may not see when you do your due diligence. Hey, you can buy a property, and I think we had a situation where we bought a property. We had no idea that property had bees in it. It was not there at the time. When the weather changed, it was infested. That was something totally unexpected, and it's an expense that we didn't anticipate. But that's a significant expense to have to deal with it, right? So, item number 7, thou shalt have knowledge of a knowledgeable realtor. So that is a ally for you. Make sure you have a realtor that knows investments, that can help you. Make sure they know the market that you're investing into as well. Item number 8, thou shalt obtain multiple repair bids. Don't just go with the first contractor. Go and get multiple bids. Make sure the bids you're getting is reasonable for what you're doing. Now, item number 9, thou shalt have reliable contractors. That kind of relates to the first one. You want to make sure your contractors can be depended on. Item number 10, thou shalt always use a title policy. Now, we think that's very, very important. If you're buying a property and you don't have a title policy, something happens. If there's a break in the chain of title, that can affect you significantly. Now, you have that title policy, you're protected, and you don't have to worry about it that much. You can at least sleep peacefully at night.
Awesome.
Right?
Dave, let me go over a few of the technical things out there real quick. Basically, we created something that's called a periodic table. We basically selected certain cities. We're showing, the reason why I want to show this is showing different cycles in different areas. So when you're investing, when you're focused on one little area, the issue is, just like investing in any kind of investments, there's cycles, they're cyclical, right? Some cities are going to have great performance one year, and it may have terrible performance another. So this one in Houston, look, Jersey City had great performances, and it also had the lowest performances too. So invest by allocating wherever. But the thing is, don't just focus on one area and you're not getting enough return, and you're like, oh crap, this is not what I wanted. Okay. This is just a precursor to let you know, as of October of 2020, this is a heat map of showing where the pre-foreclosures are in the Houston area. And then this is same thing, periodic table for the DFW area. And I also have attached the pre-foreclosure heat map to show you where all the foreclosures are coming in terms of the DFW.
Can we get a picture of those later on? I could throw up in the page.
Absolutely. You like those?
Yeah, look, I
That's
love
something I created on the
love maps.
periodic table. It's
Yeah.
taking time to do those things. I'm very analytical, so I love those things. But in terms of, this is something that I don't know if you want me to go over this if we have enough time, but I'll breeze through it. I created a risk return analysis for flips. And this is something that we use actual flips that we've helped clients with in the past. We indexed it with something that's called the NAREIT. And we also put the S&P 500 in there to compare the two, to kind of dictate what kind of risk return that this investment is. So if you look at it, this little X is the flip strategy that we help folks implement. If you look at the quadrant, it's the northwest quadrant of the chart, which means the least amounts of risk, but the highest amount of return.
For all
So
the finance people, this is called a Sharpe ratio if you want to take it in a different way. But yeah, if you're in the top left, it's usually a great sign that you're doing something pretty right, and there's a lot less downside risk.
Not a whole lot of people know what a Sharpe ratio is. The reason why I know this is I used to be an analyst for Smith Barney.
Okay, I see it.
And if you look, this is very stock oriented in terms of
Yeah.
the way the flow is. And here's what it looked like in terms of a 1 year, 3 year, 5 year return going all the way to 2016. And then we'll also show the calendar returns of the S&P versus the flip. The flip strategy of the real estate just have blown it away compared to the S&P 500 over the years, right? I think the neat thing is, here's the buy and hold, the leasing strategy, right? And as you see, it's here where the little cross is that's going up and down, right? It is still beating the S&P 500 by a mile. So it is taking less risk and it's returning a higher return. That's what makes it a great investment compared to stocks and bonds and stuff. Then here is returns for the rentals versus its benchmark in the calendar returns. Now, I want to just speed through there and then talk a little bit about our property management company. This is basically, this is kind of the structure of our property management company. We have 3 people on the second level. The company is on top, and then myself, David, and we also have an attorney that's in-house. She's our legal counsel. She's the person who's going to keep our noses clean. She's the person who's going to try to eliminate any type of possible lawsuits, because in property management, that's the most litigated in real estate. Okay, so people are sue happy sometimes. So we love the fact that we have her on our team, because she keeps us from having to deal with some of the problems that could come. And then we have, we have Michael Vu. Michael Vu is our office manager, and underneath him, we have all the different realtors that's going to help us list properties as depending on where the properties are. So we try to get different realtors to list different properties because we want the best service we can. You know, we can't list every property out there, and we want to give it to different realtors so they can focus the time and energy to make sure that we get the maximum exposure on those properties. So in terms of the professional service that we provide in terms of our property management, we'll do our background checks. We will set up a repair escrow account for each property from the landlord. So we'll require the landlord to deposit a little bit of money in there just in case while we're managing it, something happens and we need some money to make repairs. So it's there, right? Now, our job is to collect and disperse rent. So we'll collect the money and then we'll disperse it to the landlords as soon as we get the money, right? We'll make property inspections. We'll go check on the tenants, make sure they're taking care of the property. You want to make sure a property management company will do that. If they don't do that, you don't know if the tenants tore up your house or not, right? And if you checked on it 6 months down the line and you're like, wow, these guys, they don't care about our client's property, there could be a decision that's made that we may not renew on these folks. We might want somebody better to take care of the property, right? So this is something that to me is kind of important. Now we'll take care of evictions and notices. We'll do year-end income and expense reports for you guys. In our in-house counsel, as I told you, they kind of try to make sure that we're following all the bylaws and the laws, and also kind of keep us where we're not getting in trouble with anything, right? Our background checks would pretty much kind of look at a tenant's credit history, rental history, criminal history, and employment history, and also an eviction history. The things that's really important to me is they got to be able to make enough money. If they can't afford the property, there's no point of putting them in when you got to evict them 2 months down the line, right? So if they have something on their eviction, it shows a pattern also. So we look at that stuff also. The other thing is the rental history. What is their current tenant saying, or their previous, I'm sorry, landlord? What about their previous landlords? So the criminal history, some things we worry about, some things, we don't worry about, because a lot of people have DUIs or something. Sometimes things like that happen. But if they're a registered sex offender, we don't like those. We prefer to not take those a lot of the times. And I know certain states, you guys aren't allowed to do criminal background checks, but in Texas, you still can, okay? The cost of property management, basically, this is fairly common across the board. So when we rent a property for a landlord, typically we charge 1 month's rent as per for commissions. And the commissions are paid for the listing side, half of it. Another half goes to the leasing side. Typically there's 2 realtors involved a lot of the times, and that's why that's there. Now, after that, the 10% property management fee is implemented. As we collect, let's say it's $1,000, it's rent, we will take $100, and then $900 will be sent to our landlord. So if there is a renewal, we actually do not charge any type of renewal fees. Okay, most property managers will take about half of 1 month's rent on renewal fees. Also, our company does not charge any type of repair fees. So if we make a repair and a subcontractor or a contractor charged $150 to steam clean your carpet, well, that's the bill you get. We don't add on top of it and say, hey, we're going to add an extra 25 for our pockets. We don't do that. We feel like, if you're charging a management fee already, it's already set there. You're getting paid already. That's part of your job. Okay. Eviction fees, there is a charge for that because there's a court cost, and the cost differs from one court to another court because they're different counties and stuff. And our attorney will do all the evictions, and she'll charge a fee for her eviction cost. Okay.
For everyone curious too, by the way, those are pretty standard fees. First month's rent is usually what you pay an agent to help fill your space, and 10% is usually what you get for property management on a single family. So those are all pretty standard, but they actually do cut some of the fees because I have seen renewal fees and extra fees that they charge if there's a maintenance thing that like a property manager has to go out to. So
we don't believe in those because we believe that we're being paid management fees already, and we believe that's called double dipping. But a lot of property managements will do that, and we just believe in giving value to our clients. It's what it is. This slide is just an example of a property that we flipped. So it's something that flipping a property is not always the right move for everybody. But for some folks, it is an interesting way to produce income. Okay, this is just an example of a property that we helped somebody buy and leased. Okay, and some of those are cost us there. And what we'll do is, Nelson, I can email you this PowerPoint, and you can distribute it to your audience if they want it. And we're happy to give it to them so they can see what the numbers are. And these are actual numbers of a property that we purchased in Houston, Texas. I think it was 76,000, and this one was in really good condition. It only cost $5,000 to fix, and the ARV was worth 130,000. So it was pretty nice of an investment. Okay, so this is just the example of the inside of that house that that we made repairs on. And I know you guys were pushing for time, so I thought I'd power through the second half of the
Appreciate it.
presentation. Did we leave enough time for you guys?
I think we did. All right, let's go for questions. We have 10 minutes, so ask what you can while we have Michael and David here. Anything about putting in offers, just general management questions, feel free to speak up.
Hey, I had a quick question about foreclosures. So are those the ones that you usually find on auction sites, or can real estate agents also help you buy those, or how exactly does that work?
I'll take that question. That's my specialty. Auction websites does have foreclosures on there, but also auction.com, Zome, and all these folks, they also have retail products on there. And also a lot of products called CWCOT is on there. I don't know if you guys know what CWCOT is. It's
I don't.
basically a product that HUD came up with back in the 1990s, I believe. It's conveyance without a title. So basically, they sell. It's kind of like selling the note to you. Okay, you're buying it, and when they first started getting popular was about maybe 7-8 years ago. It used to be where you were able to get it for about 25% less than what the note value was, but now it's gotten the margin has gotten thinner and thinner. So you'll see those on there also in terms of the auctions. Now foreclosures are sold on the MLS also. Real estate agents can help you on auctions. Real estate agents can help you on the MLS, okay? What city are you in?
I live in Seattle.
Seattle.
Yeah.
I mean, Seattle, you know, there is some experts I know up there that does foreclosures. You know, I think is imperative that you get with somebody who really knows how the asset managers think and how they work, right? And that's just where they have experience and they have a great relationship. Now, if you're buying foreclosures for investment, there's a lot of products out there that the first look program is to owner occupants first. So you kind of don't get the first dibs as an investor. They kind of favor owner occupancy, you know, because a lot of times it's probably tied to a governmental program like a Fannie product, Freddie product. And I know HUD has that product. HUD has it, I believe, where you have to wait until after 15 days before you can start bidding as a investor. So
Fannie, Freddie, and HUD are all government organizations, essentially. So just a clarifier for everyone curious, they're not individual private organizations. They're, well, kind of, but yeah, just wanted to put a disclaimer out there. But yeah, more questions?
Quick follow-up to that. So if you're buying like for properties that are foreclosed, I'm assuming you probably have to pay cash, right? That's not something you can finance.
no,
or
that's not true. True. Yeah, I mean, Dave will tell you, he does a lot of the HUD down there for us in Houston. We've seen FHA loans. We've seen conventional products. We've seen USDA products, all purchase those. So it's where certain programs will allow you to use whatever loan it is, like HUD. HUD is something that, you know, you can have a cash offer, a loan offer, a FHA or conventional product. That if the loan product is higher, they look at the net number. So if the loan product is $150 higher, they actually typically will pick the $158 higher offer that's net to HUD.
I see. Thank you so much.
Sure. Now, in my opinion, though, all of you young investors out there, I think the discounts are not necessarily all in the foreclosure market, okay? The discounts are really in the off-market market if you are going to get into investing. You know, foreclosures, if you go back 10 years ago, yeah, you can get a good product back then. But the banks and all these folks have really squeezed the margins. But also it's with all this popular TV shows, Flip That Home and whatever, and Property Brothers and stuff, right? So all these TV shows on remodeling homes have brought out so many people into the investment world, and it became where inventory was scarce. And when inventory is scarce, well, it drove up the pricing and it squeezed the margins. So
Makes sense. All right, no other questions?